Markets are starting to talk about commodities again. But the real signal is not that prices moved higher, it is what still has not happened underneath the surface. In our strategy, we do not start with stories or headlines. We start with supply, demand, and where capital is positioned, versus where it may eventually be forced to go. This discussion is grounded in a recent long-cycle commodities conversation that focused on mining, energy, and real assets. Rather than debating how high prices can go, we are asking a different question. Has the system that produces future supply actually adjusted yet? Historically, commodity cycles move in a sequence. Prices respond first. Capital follows later, supply responds last. The gap between price signals and real supply response is where volatility and asymmetry tend to live. One of the most important signals discussed is discovery. Over the last 2 years, large-scale discoveries in copper and gold have effectively collapsed. That matters because discovery is usually what accelerates near the end of a cycle, not near the beginning. In past cycle peaks, discoveries surged, capital spending exploded, and new supply rushed forward. Today, we are seeing the opposite. That pattern historically aligns with early to middle cycle dynamics, not exhaustion. At the same time, structural demand continues to expand. Data centers, grid rebuilds, onshoring, electrification, and defense infrastructure all pull from the same pool of materials. That demand does not arrive all at once, but it compounds over time. Markets often assume supply will respond quickly. In mining, it rarely does. Permitting, financing, political risk, and long lead times slow everything down. That is why prices can move far ahead of production. This is also why volatility does not automatically signal a top. Sharp pullbacks tend to test positioning and psychology, not the structure itself. If this kind of framework-based thinking is useful, subscribing helps you build pattern recognition over time. You start seeing how cycles actually evolve, where markets misread timing, and which signals matter more than price alone. Now, a quick note before we go further. This is educational analysis, not financial advice. We focus on probabilities, sequencing, and risk awareness, not predictions or trade recommendations. From a phase perspective, this environment most closely resembles a late phase 2 setup. Awareness is rising, but capital commitment still lags. Policy is beginning to respond, but policy tends to delay outcomes, not resolve structural constraints. What would change this view is not price strength or weakness. It would be a surge in major discoveries, sustained mining capital spending, or rapid production expansion across multiple metals. What has not changed is the slow nature of supply response, the fragmentation of global trade, and the under-ownership of mining relative to global equities. The takeaway is simple. This is not about chasing prices. It is about understanding where the system is tight while narratives still assume abundance. In our strategy, we do not need to be early. We just cannot afford to be late.